Okay, so let's start. We want to start this new topic. Our topic is called conversion of a partnership into a limited company. That's the one we want to do now. Let me introduce it. Let me introduce the topic now. As a partnership, you are running your business as a partnership. You may want to convert it into a limited company. How do you convert a partnership into a limited company? That's what we want to talk about now. Okay? Now, so let us assume you have been operating your business as a partnership of partner A, B, and C. You want to convert your partnership into a limited company. Let's call it XYZ Limited. Okay? So in the process of converting your partnership into a limited company, in other words, we normally say you as partners, you are supposed to close your business and sell your business to the company. You are closing your business and you sell your business to the company. So these partners normally are required to close their books. They are normally required to close their books. ABC Limited, no, XYZ Limited, on the other hand, they will be required to open their books. So partners close their books, XYZ Limited open their books. Now, when you are converting your partnership into a limited company, the partners of this business, before they sell their business to the company, normally they should be paid what is due them. It's like they are selling their business or their partnership business to a limited company. So we want to look at how do you as ABC Limited close your books and how will XYZ Limited open their books. That's what we want to talk about now. Let me start with the entries. We can even call this business of A and B, C partners, we can call it like the selling business. It's like they're selling their business to the company. Okay? So in other words, we are looking at the closing entries in the books of the partners. So let me start. Don't write. What are the entries in the books of? In the books of the partnership. In the books of the partnership. What are the accounting entries in the books of partnership? Now, whatever assets, listen, whatever assets you as partners are giving to the companies, you as partners, you are supposed to close all assets taken over. Company XYZ could have said they are going to take over your motor vehicle, they are going to take over your furniture, they are going to take over your stocks, and so on. So the first thing you as partners you do is that with all assets taken over, you close all assets taken over, close all the assets taken over at their book values, to an account we shall be calling, realization account, to an account we shall be calling realization account. Let me open it here. It's the major account, the books of the partners. So I've said number one, close all assets taken over at their book values to the realization account. So the question will tell you, furniture was taken over by partner or the company, motor vehicle the same. We close all those assets by crediting them and debiting realization. That's step number one, which says close all assets taken over by crediting the assets and debiting realization. That's number one. Number two, you as partners, you have some liabilities. Could be creditors, loans, and so on. This new company says they will take over that liability from you. So number 2 is with the liabilities taken over. With your liabilities taken over, what do? You have liabilities like creditors. The company says he will take over your liabilities. So again, you as partners close those liabilities. How? By debiting the liability and crediting realization. You debit the liability and you credit. We know liabilities are always a credit balance. Therefore, to close them, you will credit the liability, you will debit the liability and credit realization. That's always number 2, which says with liabilities taken over, you debit liabilities, credit realization. You credit realization. Okay? That's number 2. Number 3, we have already said that you as partners, you are selling your business to the company. You're selling your business to the company. So there must be something you are charging the company. There must be something you are charging the company to buy you. That which you are charging them, we normally refer to it as the purchase consideration. We normally refer to it as the purchase consideration. What is it that you as partners, you are charging the company? Let us assume for purpose of illustration that you are charging the company 50 million to buy you. You as partners, listen, you are charging XYZ Limited that 50 million. So you will debit, listen, you will debit that account called XYZ Limited by that 50 million and you will credit realization. And you will credit realization. Listen, that 50 million, I am charging the company. Listen, I am not saying that they are paying me 50 million. No, I am charging them. They will pay me later. But as at now, let me create a data. Me as partners, or we as partners, we are creating a data by the name, of XYZ Limited. So with the purchase consideration, you debit the purchasing company, credit realization. Credit realization. Good. Now listen. You as partners, we have said, you will close your business. In other words, it's like you are liquidating your partnership. You as partners, it's like you are liquidating your business so that you sell your business to the new company. So ideally, you are liquidating yourself. In the process of liquidating yourself, listen, you may incur what we call dissolution expenses. You are dissolving yourself. Once you dissolve your partnership, you may incur some dissolution expense. So number 4 says, whatever are the dissolution expenses, if any, not always will they be there, no. But in some questions, yes. In some questions, no. With dissolution expenses, you incurred some dissolution expense to dissolve yourself or to liquidate yourself. You as partners, you will debit realization, whatever are the liquidation expenses or dissolution expenses. With the dissolution expenses, debit realization and you will credit bank. You will debit realization and you will credit bank with what we are calling solution expenses. With solution expenses. That's our entry number 4. That's our entry number 4. So let me talk about number 5. That's number 4. Let me talk about number 5. But maybe before I talk about number 5, listen. Before I talk about number 5, number 1, we have said 1, close all assets taken over. Number 2, with liabilities taken over. You take them to where? Realization. Number 3, with the purchase consideration, create a data. by the name of the company buying you. 4, we have said with dissolution expenses, debit realization, you credit bank because you paid. Now, before we continue, let me mention this to the new students. Some students have joined us. They are new to us now. Some students have joined us. Please listen to this. If you are a new student or you are watching this for the first time and you have not subscribed to our YouTube channel, please subscribe. If you're new, you have not subscribed to my YouTube channel, please subscribe. Just click that subscription button as you are watching even now. Please subscribe. Click that subscription button and also click the notification bell so that you may be notified whenever we post new videos into the YouTube. Whenever you post new videos into the YouTube. So if you are new and you have not subscribed, please subscribe. Okay? Now to everyone now again. Please tell your friends. Please tell your friends that we have online classes for financial reporting of the intermediate level, which is what we are now doing. Tell your friends that if they want to join us for online classes, we have online classes for financial reporting of the intermediate, the one we are doing. We also have advanced financial reporting of the advanced level, and we also have financial accounting of the foundation level and of the ATD level 1 and level 2. There is also accounting there. So these are the 3 papers we are offering online classes for. For advanced financial reporting, we have either early morning classes or evening classes. We have early morning or evening. Somebody can choose. Our early morning starts at 5:30 in the morning, 7. Our evening starts from 8 to 10. From 8 to 10. Okay. For financial reporting, as at now, only in the evening. Only in evening. Now, it may be possible that if you join this class, tell your fellow students that if they join the class, whether financial reporting or advanced financial reporting, and for whatever reason one day they miss a class, they can still watch the video of the class that they missed. Whenever a student misses a lesson, tell them that they can still watch the video of the class that they missed. They just go back to the group where the link is, click on the link, and they can be able to watch the video of the class that they missed. Okay? So whenever somebody misses a class, even you as a current student, whenever you miss a class, don't panic. Just go back to the group. You'll get the link of the class that you missed, and you can watch it at any other free time. Okay? Another point is, tell your friends if they are not able to join the live classes, then they can still buy what we call pre-recorded videos. They can buy what we call pre-recorded videos, where they get the videos for the whole syllabus. They get the videos for the whole syllabus. They can watch the videos at their own free time. So if they are not able to join the live class, then they can buy the videos, whether for financial reporting or advanced financial reporting or financial accounting of the foundation level. Yeah, they can still watch the videos at their own free time by buying what we are calling pre-recorded videos. For anyone interested, they can get me in through this number. Tell them they can call through this number 0722 6588 0722 658875. That's what we have. Okay? 0722 658875. That's somebody wants to reach us. Reach me through that number. Okay? Good. I think that's all I wanted to mention for the new students who have joined us. Please subscribe if you have not subscribed. You can even click that subscription button right now. Then 2, we talked about informing your friends about our online classes, which are live or pre-recorded classes, pre-recorded videos. Then somebody can reach me through this number. That is 0722658875. Currently, we are charging 4,200. We also accept payments on installments. We also accept payments on installments. Okay, I think that's all I wanted to say. Let me continue now. Let me continue now. Good. So I was discussing my entry number 5. Let me go to number 5 now. Let me go to number 5. Let me go to number 5 now. Number 4 is where we have said, in case you incur a dissolution expense. Okay, number 5, listen, I want to take you back to number 1. Number 5, I want to take you back to number 1. We are going back to our entries now. Number 1, I said, close all assets taken over. Close all assets taken over. Listen, one partner may say, because we are dissolving our partnership, and you will still end up paying me what is due to me, why can't you give me this motor vehicle as part of my payment? One partner could say something of that nature, that we don't give that motor vehicle to the company, but we use it, pay that partner what is due to him. So our number 5 entry says, in case an asset is taken over by a partner, that is, in case an asset is taken over, any assets taken over by a partner, what do? You will pay that partner using that asset. So you will debit, listen, you will debit the partner's capital account because you are paying that partner. Remember, it is in the capital account that you owe the partners. Okay? When I'm paying them, I normally pay them through their capital accounts. So when an asset is taken over by a partner, debit the partner's capital account and you credit the asset. Okay? That's what we are saying. That's what we are saying. Let me go to the next one. Now. That's number 5. Number 6. Listen. I told you we are dissolving our partnership. And when you dissolve a business or any partnership, by the end of the day, there should be no account pending. Suppose, sin again, but when I told you, close all assets taken over. Number 5, we have said, with assets taken over by a partner. What if, again, you have an asset which company XYZ decided they are not going to take over? At the same time, no partner wants to take it over. Yet, we have said you can't dissolve this business and leave accounts pending. No. So you as a partnership, you may decide to sell that asset on your own because XYZ is not taking it over. No partner is willing to take it over. So you decided, let us sell this asset. Maybe it's a motor vehicle, furniture, whatever it is. So we are saying, number 6 says, with any assets not taken over. With any assets not taken over but sold. With any assets not taken over but sold by the business. Okay? What do? Have an asset. Let us assume this is a motor vehicle. It has a book value of 2 million. You sold it for 1.5 million. You sold it for 1.5 million. So you must have debited bank. You must have credited the asset by 1.5 million. There is a balance in this account. Can't leave it pending. That balance being a gain or loss on disposal, take it to the realization account. Remember, we are not running a normal business. We are dissolving our partnership. So, if it was a normal business, the gain or loss on disposal will go to the normal P&L account. But now we are not running a normal business. we are dissolving or liquidating this partnership. So whatever is the gain or loss, take it to the operating account. And our operating account is the realization account. That's our entry number what? Number 6. I think number 6. Yes. Which says, with any assets not taken over by the company, but sold by the partnership, we will debit bank, credit the asset. If there's any gain or loss on disposal, that gain or loss should be transferred to the realization account. Good. Number 7. For number 7, I want to take you back to number 2 now. 7, I want to take you back to number 2. Number 2, what did we say? With the liabilities taken over by the company. With the liabilities taken over by the purchasing company. What did we say? We said you debit liability because you are closing them, and we said you credit realization. Okay? What if, now listen again, what if you are told by the question that the company did not want to take over your creditors? The company did not want to take over your creditors. What did you decide to do as a partnership? You may decide to pay it on your own. So with any liabilities not taken over, with any liabilities not taken over by the company, but paid by the partnership. Whatever liabilities, we know liabilities are always a credit balance. Let's use creditors as an illustration. Let's use creditors as an illustration. So you know creditors are a liability. Came and said your balance brought down. Let us assume 2 million. Then the question tells you, these creditors, listen, these creditors were willing to accept 1.8 million in full settlement. Willing to accept 1.8 million in full settlement. So you came and debited creditors 1.8 million and you credited bank. Again, listen, we can't leave the account pending. We owed them 2 million. They were willing to accept 1.8 million in full. So it is obvious the creditors have given us a discount. So we have what we call discount received of 200, which means you will debit creditors in, listen, in a normal business, I would have taken that gain, the P&L account. Now we are not running a normal business, we're saying it is a liquidation or dissolution case. Take it to the operating account, which is which account? The realization account. That's our entry number 7, which says, with the liabilities not taken over, paid by the business. Number 8. 8, again, listen. 8, listen. You have another liability, which the new company could decided not to take over in number 2, sorry. They have, or as a partnership, have another liability, which company B or XYZ did not want to take it over under note number 2 or step 2. At the same time, you did not have money to pay. You as a partnership, you did not have money to pay that liability under step number 7. Yet, they have said, you can't leave some accounts pending. What do? Maybe we have a loan. The new company doesn't want to take it over. 2, as a partnership, we have no money to pay. What do? Listen to this now. What you can do as partners or as a partnership, you may approach one of your partners to take over that liability. You tell him, see, we are selling our business to this company. Please take over this liability when they shall pay us the 50 million. Because we shall have to share it, and we asking you to take over this liability for now, we shall owe you that amount. So when it comes to time of payment, you will be paid more. So a partner may decide, okay, fine, let me take over your liability as a partnership. Let me, as a partner on my own, let me take over that liability. That's what we are saying as step number 8. With liabilities taken over, with any liabilities taken over by a partner, that means he assumes the responsibility of that liability. So you again know liability is a credit balance. Close it by debiting the liability and crediting what? The partner's capital account. Listen, it's an amount that you owe to that partner. Because you owe it to the partner, you increase what you owe the partners. Increase what you owe to that partner. That's our entry number 8. If there's any liabilities taken, not taken over by the company, not paid by the partnership, requested a partner to take it over, that's what we are saying. The liability is taken over by a partner, saying you debit that liability, credit the partner's capital account. Good. Now, we go to number 9. Go to number 9 now. Go to number 9. Now listen to number 9. We are selling our business. We are selling our business to the company. We have opened an account called realization account. There could be a balance in this account. There could be a balance in this account. That balance in this account will either be a gain or loss on selling your partnership. Selling your partnership to a new company. So whatever is the balancing figure in the realization account, that will automatically be either gain or loss on realization. Look at it this way. We as a partnership, we are charging XYZ Limited 50 million. These are the assets we gave him, plus the dissolution expense we are incurring. Suppose what we are receiving on the credit side is more than what we are giving on the debit side. What does it imply? It implies that we have sold our business again. Means you are receiving more by giving out less. If what you are receiving is more than what you are giving, then you as a partnership are selling your business at a gain. What if what we are giving out on the debit is more than what we are receiving on the credit? That automatically tells you that you are selling your partnership at a loss. Whatever is the gain or loss on realization, whatever is the gain or loss on realization, listen, that gain or loss should be shared between the partners according to their profit and loss sharing ratio. If it's a gain, then it will be on the debit side. Come and see your partner A, B, and C. Whatever is their profit and loss sharing ratio, share that gain according to that ratio. If it's a loss, meaning you gave out more on the debit than what we are receiving on the credit, being a loss, you will credit realization and you will debit the partner's capital account. And you will debit the partner's capital account. So that's our entry. Number what? I think number 8. Number 9. That is number 9. It says with the balance in the realization account. With the balance in the realization account being either gain or loss. Okay? Now listen. Before I go to the other entries, because there are about 14 entries, listen. Some of these entries I've mentioned are not very common in all questions of your conversion. There are some which are obvious. You will have to get them in any question. Like, for example, closing the assets taken over, that entry will be there. The liabilities taken over, that entry will be there. Purchase consideration, that entry will be there. Okay? Dissolution expenses, not a must. Not a must. Okay? Assets taken over by a partner, Not a must. Not a must. Some questions don't have it. Assets sold, not a must. Our liability is not taken over by a partner, but paid, not a must. Next, liabilities taken over by a partner, not a must. Balance in the realization, you must. Okay? So the number 4, listen, the entry number 4 to number 8, it's not a must. So don't panic that these 2 entries are too many. We are just discussing them just in case one or 2 may be added as part of the additional information where you are told a partner took over an asset. What do? You are paying him using that asset. So logic will tell you debit partner's capital account because you are paying him. You credit the asset. If you sold the asset, normal double entry, even without knowing, you debit bank, credit the asset. It's only that now the gain or loss, take it where? To the realization. If a partner took over liability, logic says you owe him as a business, you owe him for that amount. So increase what you owe him. Debit that liability, credit his capital account. You getting? A partnership paid their own liability. Number 7, for example. That's normal double entry. Debit that liability, credit bank. It's only that I said, is any discount you are receiving from the creditors, now don't take it to P&L, take it to the realization account. So those other small entries like dissolution expenses, assets taken over, assets not taken over but sold, those are normal entries. You can use your concept of double entry to remember. Otherwise, as far as we have gone now, I could say 1, close the assets taken over, liabilities taken over, purchase consideration, the balance in the realization. Yeah, good. So before I go to number 10, 11, and so on, let's put down something on what we have already said. Let's put down something what we have already said. So the topic is conversion. Put down the topic. Topic is conversion of a partnership into a limited company. Conversion of a partnership into a limited company. That is the topic. Conversion partnership into a limited company. Conversion of a partnership into a limited company. Okay. Maybe there is an introductory statement. You can put down this. Put down this introductory statement. A partnership business may be converted. A partnership business may be converted into a company. A partnership business may be converted into a limited company. Due to one of the following reasons. Due to one of the following reasons. Or in other words, saying, why do you as partners want to convert your partnership into a limited company? There are different reasons why you could do it. Of course, you have done law. Think you should have talked about this. Advantages of a company over a partnership, you know them. Are you there? It's the same concept we are saying. What are some of the advantages of running your business as a company as opposed to a partnership? That's the same thing. Listen, for example, you know a company can easily access capital from external investors. A partnership, that one could be one of them. Another reason, don't write fast. Another reason is, as a company, you know you have this status called limited liability, whereby If the company is unable to pay their debt, then the personal property of the shareholders will not be taken over. But in a partnership, if the partner is not able to pay, then the partner's personal assets may be taken. You know that? Another one we have said is for expansion. You may want to get more capital. As a company, you have more access to capital than partnership. That's one. You have talked about what? Limited liability status. Number three, you know a company can own assets in their own name. Company can own assets in their own name. You know another reason, listen, when a partner dies or retires, that may lead to liquidation of a partnership. You know that. But when a shareholder dies in a company, that does not stop the company from going on. So there is perpetuity or continuity in a company as compared to a partnership. So let's put down some of those reasons. So we have said for the following reasons. One, for expansion purposes. For expansion purposes. One, for expansion purposes. When I say for expansion, of course you know. You can expound on that on your own words, able to access capital, blah, 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 and so on. Okay? That's number one, for expansion purposes. Number two, for perpetual succession. For perpetual succession. Two, for perpetual succession. That means the company will still continue even if a shareholder dies. Perpetual succession. Three, to own property. Company may own property in your own names. To own property. Own property. Four, to enjoy limited liability status. Enjoy limited liability status. Enjoy limited liability status. To enjoy limited liability status. Good. Another paragraph. Another paragraph. On conversion of a partnership. On conversion of a partnership business. On conversion of a partnership business into a limited company. On conversion of a partnership into a limited company, the partnership business is dissolved. Partnership business is dissolved. And the new company comes into existence. New company comes into existence. And a new company comes into existence. See, partnership is dissolved and a new company comes into existence. Now have another subheading. Entries in the books of the partnership. Entries in the books of the partnership. Entries in the books of the partnership. Can even put in bracket closing business. Closing business so that you remember you are closing their business. Entries in the books of the partnership. In other words, closing business. Number one. Let's put it down here. Come here. Number one, close all assets. Close all assets taken over. Close all assets taken over at their book values. Close all assets taken over at their book values. Close all assets taken over by the company. Maybe you can even put it that way. Close all assets taken over by the company at their book values close all assets taken over company at their book values to the realization account. To the realization account. Close all assets taken over by the company at their book values to the realization account. Therefore, put down the double entry, debit realization, credit assets. Debit realization, credit assets. Debit realization, credit assets. Debit realization, credit assets. That's number one. Let's go to number two now. Two, and the KIB with liabilities taken over. With liabilities taken over by the new company. With the liabilities taken over by the new company. Debit, liabilities, credit realization. Debit, liabilities, credit realization. Debit, liabilities, credit realization. Yeah? That's number two. Three, with the purchase consideration. With the purchase consideration. With the purchase consideration. Debit, purchasing company. Debit, purchasing company. Of course, the question will tell you the name of the company. For now, just put in bracket data. Remember, I was charging XYZ 50 million. We are creating a data by now. Debit, purchasing company, and your credit realization. And your credit realization. Debit, purchasing company, and your credit realization. Yeah? Good. That's number three. Four, with dissolution expenses. With the dissolution expenses. With dissolution expenses. Debit realization. Debit realization. Credit bank. Debit realization. Credit bank. With the dissolution expenses. Debit realization. Credit bank. Yeah? That's number four. Number five. Down this. Five. If true. With assets not taken over. With assets not taken over by the company. With assets not taken over by the new company. Put it that way. Assets not taken over by the new company. But sold. By the partnership. Any assets not taken over by the company, sold by the partnership. Debit bank, credit asset. Any asset not taken over by the company, sold. Partnership, debit bank, credit assets. Ikapo chini NB, with the balance in the asset account. Balance in the asset account being a gain or loss on disposal. Balance in the asset account being a gain or loss on disposal. Being a gain or loss on disposal. Transferred to the realization account. Transferred to the realization account. Transferred to the realization account. That's number five. Number six. Transferred to the realization account. 6. Number 6. With any asset taken over by a partner. Any asset taken over by a partner. Any asset taken over by a partner. Any asset taken over by a partner at agreed values. Whatever the value will agree. Any asset taken over by a partner at agreed values. Debit partner's capital account. Debit partner's capital account. Debit partner's capital account. Credit asset. Debit partner's capital account. Credit asset. Remember, this is an asset we said we are using to pay a partner. That partner said, instead of selling this motor vehicle, or instead of giving out to the new company, why can't you use it to pay me? As a business, we gave him. Debit his capital account as part of his payment. Then we credit the asset. 6. Number 7. 7. 7. With the liabilities not taken over. 7. The liabilities not taken over by the new company. Liabilities not taken over by the new company, but paid by the partnership. Any liabilities not taken over by the company, but paid by the partnership. Paid by the partnership business. Paid by the partnership business. Any liabilities not taken over by the company, paid by the partnership business. Debit liabilities, obvious we are paying it. Debit liabilities, credit bank. Debit liabilities, credit bank. Debit liabilities, credit bank. Below that, unaweza andika NB. Below that, andika NB. And you say this. With any discount received from creditors, any discount received from creditors, any discount received from creditors, debit creditors, credit realization. Debit creditors, credit realization. Debit creditors, credit realization. Okay, that's number 8. Let's go to number 9. That's number 7, sorry. Go to number 8. 8. Ivy. 8. With any liability taken over. Any liability taken over by a partner. Any liability taken over by a partner. Any liability taken over by a partner. Debit liability. Remember, we are closing it. Debit liability. Credit partners capital account. Credit partners capital account. Remember, we owe that partner. Any liabilities taken over by a partner, we increase what we owe to that partner by debiting the ability to close it, and we credit the partner's capital account. We credit the partner's capital account. That's our entry 8. Go to number 9. That's where we were discussing the last one. Go to number 9. Go to number 9. Let me down. Number 9, we said this. 9, we had said this with the balance in the realization account. Balance in the realization account. Balance in the realization account being either balance in the realization account being either a gain or loss on realization. Balance in the realization account being either gain or loss on realization. Being either gain or loss on realization, comma, share it between the partners. Share it between the partners. Share it between the partners according to their profit and loss sharing ratio. Balance in the realization account being either gain or loss on realization. Share it between the partners according to their profit and loss sharing ratio. Then below that unaweza kusema number A, if gain, debit realization, credit partners capital account, credit partners capital account, credit partners capital account, debit realization, credit partners capital account. B, number B below that, if loss, debit partners capital account, debit partners capital account, they take over the loss, debit the partners capital account, and we credit realization. That's how far we have gone, the books of the partnership. Let me talk about number 10. Let me talk about number 10 now. Talk about number 10. Hope you are through with the copying. Okay, so let's continue now if you are through. Let's continue now if you're through. Okay, so let me go now to number 10. Listen to this now. This is where we were. We are at number 10. Listen now. These partners decided, the partners decided they will convert their partnership at the end of the year. So they have been trading for the whole year, but they decided to convert their partnership into a company by December. What does it mean? It means for the whole of this year, they have been trading as partnership. So there must be something they made during the year. You know how to prepare the appropriation account. So obviously, there was an appropriation, profit and loss appropriation. There was a profit that was made during the year, or they converted. So that means in a partnership, you know, there is always what we call profit and loss appropriation, where we normally bring in the net profit, the credit side. Once you get it in the normal income statement, normally bring it on the credit in the appropriation account. Then we normally appropriate the profit according to the rules of partnership. One thing that can be paid out of this profit, you know, is what in a partnership? When you are preparing the appropriation account, one of them is what you call interest on what? Interest on capital. So partner A will get that much, 10%, whatever it is. Partner B the same, whatever it is. Okay. Another thing that we normally take to the appropriation account, you know, is something like salaries to partners. You have done partnership. So any salaries to partners, listen, Any salaries to partners are not expenses to the partnership. They are considered as appropriation of profit. No, you know that, okay? Things like salary, partners, some books will call it commission, partners. Those are not expenses. They are considered as appropriations of profit. Good. You also know, listen, if there was any interest on drawing, you as a partnership, you are charging partners interest on their drawing. That's like an income to the partnership. Any interest on drawings, you know, it's normally credited. Interest on drawing, like an income. Maybe it was partner A, B, and C who drew some money out of the business and they are charging them interest. Okay? Listen, assuming you have done all the appropriations, then there is a balancing figure which we normally share as a profit, or share it as a loss. Let me assume, came and said, got a share of profit. Come and share the profit between A, B, and C. So what I'm trying to say under number 10, listen to this now. Under number 10, what I'm trying to say is that in case, listen, in case there is an undistributed profit, distribute it. In case these partners, of course, if they were converting their partnership by the beginning of the year, then there will be nothing to undistributed. But if they traded, even maybe for 6 months before they converted, or they traded for a whole year before they converted, then that period where they were still partners, whatever profit the partners made, share it as whose of the partnership. That's why we are saying you distribute whatever is the undistributed profit. I've taken you through appropriate the profit. You are preparing the appropriation account. You pay interest on capital out of it, pay salaries to partners or what they call commission. Then you charge interest on drawings if the question has it. Then whatever is the balance, you normally share as a profit loss. Okay? That's our entry number 10, which says we distribute or distribution of any undistributed profit. Distribute any undistributed profit. Okay? In the partners, of course, according to their profit and loss sharing ratio. Listen, let me go to number 11. But before I go to number 11, listen, you all know this from your accounting knowledge, that all these appropriations that are normally on the debit of the appropriation account, they normally go to the current account of the partners. So somewhere you must have opened, as you kept distributing these profits or appropriating the profit, as you kept debiting the appropriation account, you came and credited the partner's current account with anything like interest on capital, given them on the debit, salaries to partners, whatever the partners were getting, also given them maybe share of profit, whatever it is, give them, belongs to them. If it's interest on capital, interest on drawings, for example, I have credited the appropriation account, come and debit the partner's current account. You all know interest on drawings is normally debited in the partner's current account. And also, of course, the same drawings, whatever is the amount of the drawings themselves. Good. In other words, I'm trying to say, listen, as you did the appropriation in number 10, you must have also updated those appropriations in the current account. You must have updated current account with whatever appropriations. So it's obvious when we said distribute the undistributed profit, we did not just say prepare the appropriation account. As you prepared it, you are completing the double entry. That debited the appropriation with interest on capital, so it goes as current account. Salaries, you normally debit the appropriation, goes to the credit of the current account. Any share of profit, normally debit the appropriation, credit the partner's current account. Interest on drawings, we normally credit P&L account, go and debit the partner's current account. That's what you have been doing under number 10. When we say distribute the undistributed profit, we are not only talking about the P&L appropriation account, we're also talking about the current account. You keep updating it with the appropriation items. Are you there? Good. Now I go to number 11. I've discussed number 10, where I've said you distribute then. Number 11. Before I talk about it, let me remind you something I told you. By the end of the day, listen, at the end of the day, the partners must be paid what is due to them. We are dissolving this partnership. Partners must be paid what is due to them. Now, you can't pay the partners what is due to them through the various accounts. For example, of course, I owe the partners something through their capital account. I also owe the partners something through their current accounts. But I cannot pay partner A what I owe him in the current account through the current account. That I owe him through the capital account, I pay him through capital account. No. Everything should be consolidated. What I owe to a particular partner should be consolidated. Listen, so that when I come to pay the partners, I'll pay them only once, not in piecemeal. Not to pay them what I owe them through current, what I owe them through capital. No. I want to pay them once, but not in piecemeal. That's where number 11 comes in. Now we are saying you close the current accounts of the partners. Because you have updated them, now close the partners' current accounts. Close the partners' current accounts. To where? Their capital account. Now that you have updated the partner's current account with salaries, interest on drawings, interest on capital, share of the profit, whatever balance is now there, take it, transfer it to the capital partners. Yeah? That's our entry 11. Of course, if a partner's current account is a credit, you will debit the partner's current account and you will credit the partner's capital account. If a partner's capital account is a debit, you will credit that partner's current account and you will debit the partner's capital account. So we are closing the current accounts effectively. The credit, debit, credit the partner's capital. The partner's current account is a debit, close that debit by crediting it, then you debit the partner's capital account. That's all we can say under number 11. Under number 11. Now we come to number 12. Listen to this now. Under number 12. Listen carefully. Under number 12. I go back to number 12. I go back to number 3. What was number 3? 3, I told you, with the purchase. You're assuming how much? 50 million. You there? Good. A time has come for that company to pay us. We are the partners. And we had charged company A, no, XYZ Limited, how much? 50 million. Where is that account? Here. Good. So we debited XYZ Limited with that 50. That time, I was creating a data. But a time has come now for this XYZ Limited to pay us. Why we are saying with the receipt of the purchase consideration. Listen, XYZ Limited may decide they are going to pay you this 50 million, all of it in cash, or all of it they may give you shares as a partnership. Partners, you are given shares to become shareholders in the new company as your payment, or the company may issue debentures to you. There are many ways in which company XYZ may pay you. For purpose of illustration, let me assume they gave you cash of 10 million. They gave you shares worth 20 million. And they gave you debentures worth 20. So number 12 says, with the receipt of this purchase consideration, If you are receiving cash, you as partners, you will debit cash. Let's assume 10 million, and you'll credit the partners, you credit purchasing company 10 million. If you are receiving shares, you will debit shares. You are receiving, you as partners, you are receiving shares. You are not the company issuing, you are receiving. So to you as partners, this is an asset, not share capital. You are the one receiving shares. So to you, it's an asset. You are receiving shares as an asset. The other company is the one issuing. To them, it will be capital. But you are receiving. So whatever the amount, which I'm assuming to be 20, debit shares in XYZ Limited, and you credit purchasing company. Come and see your shares, 20 million. Okay? If you are receiving debentures, debit bank, you debit debentures. In debit debentures as an asset. You are not the company issuing the debentures, you are receiving debentures. Debit debentures and you credit the purchasing company. It is good. That's our step number what? Well, which says with the receipt of the purchase consideration, either in form of cash, shares, or what? Or debentures. If cash, you debit cash. If you are receiving shares, you debit shares. If you are receiving debentures, you debit debenture and you credit the purchasing company. Remember, in number 3, I was creating a data that time. Now I'm receiving from a data into credit account. Whatever the data is paying me with. Giving me cash, I debit cash. Giving me shares, I debit shares. It's giving me debentures, I debit debentures. Are you there? Good. That's our step number 12, which says with cash or shares or debentures received. Good. That's number what? 12, which says receipt of purchase consideration. Good. We go to number 13 now. Go to number 13. Now listen. Go to number 13 now. Listen. I told you by the end of the day, the partners must be paid what is due to them. By the end of the day, the partners must be paid what is due to them. I have also told you, you owed them something through current account. You owed them something through through their capital account. I told you, you normally have to consolidate everything into one account. That's why you transferred the balance of the current where? To the capital account. Listen. Now number 12, we have received cash. We are the partners. We have received shares. We have received debentures. Now listen. Our step number 13 says, with shares and debentures given to the partners as a payment. Not cash. Not cash. Shares or debentures given to the partners as a payment, what you owe to them. The question will tell you, these shares that we received worth 20 million, we as partners decided to settle it, used to share it how? The question will tell you, these debentures that we are receiving, how are we using it to pay ourselves? The question will tell you. Maybe all of it will go to partner A and the other guy will be given shares, whatever the question will tell you. But shares or debentures given as payment, what do you do now? You credit the shares. Remember, you received them as an asset. Debit. Credit the shares. You debit the partner's capital account. You are paying the partners now. Don't forget. You are paying the partners what is due to them, but in form of shares. So I'm giving them debentures. Remember, I received debentures as an asset. I have it as an asset. Now let me use it. I credit debentures and I debit the partners capital account. Are you there? That's our step number 10, which says shares or debentures. Share it according to the agreed proportion. Give the partners the shares, give the partners the debentures by debiting the partners' capital account, crediting shares if they are shares, crediting debentures if. Then number 14 and the last one is this. Remember, listen, I have not touched the cash. I have not touched the cash. The one I'm trying to use now as the last one. Let me come back here. Where? Yeah. Okay. Let me just prepare the account here. These are partners' capital accounts. These are partners' capital accounts. Listen, A, B, and C. Of course, there are entries there because you must have transferred the balance of the current account, blah, 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 blah. Listen. Finally, we have cash in hand. Want to use it, pay the partners. Listen, I also told you that once you dissolve the partnership, there should be no balance remaining. There should be no balance remaining. Listen. So, we have cash somewhere, a cash account somewhere, and there are these capital accounts. What do? Listen. I'll go balance the capital account of partner A, get the balance of the capital account of partner A, I note it somewhere. I don't carry down, I note that balance somewhere. Get the balance of partner B, the capital account of partner B. How much balance do we owe him? Note it somewhere. Partner C, the same. Note it somewhere. Get the totals of those three. If the total does not come to be 10 million, or assuming the total comes to be 10 million, and you had cash here of 10 million, then now you know you are safe. Listen, now you know you are safe. That what we owe the partners is 10 million. Maybe partner A, we owe him 5. Partner B, we owe him 3. Partner C, we owe him 2. 10. And in the bank account or in the cash account, the exact money we have. Now you can pay the partners. Everybody will go there. How much do I owe partner A? 5 million. Credit cash or bank by 5 million. I debit his capital account. 5 million. Partner B, I owe him how much? 3 million. That's what I owe him. I credit cash or bank, 3 million. I debit his capital account. B, through C, I owe him how much? 2 million. I credit bank. That means I give him that money. I debit the partner's capital account. That way, you have dissolved partnership. That way, you have dissolved the partnership. Therefore, everybody can go their way. Now, listen. What if, point is, what if one partner now, after we have entered everything, and we want to come and pay the partners, we realize that this partner's capital account is a debit balance. Normal cases, capital account should owe credit balance to represent that as a business, we owe the partners. But what if a partner's capital account is debit balance? If a partner's capital account is a debit, meaning he owes the company, he owes the partnership, he owes this partner's capital account being a debit balance. After doing everything, we still realize he has a debit balance in the capital. We can't pay him. Instead, it is him who owes us. So he will be required to bring in cash. When he brings in cash, debit bank, and you'll credit his capital account. Remember, it was a debit. So once he pays you, you will debit bank and credit partner's capital. I'm assuming it was partner C who had that debit balance. Now listen, once you receive from him the 3 million or the 2 million, now the money in the bank, listen again, the money in the bank should be opposite and equal to what you owe the other two partners. A and B, what do we owe them? Owe them 5 million, owe them 3 million, that comes to 8. So after receiving from partner C, whatever money is in the bank now should be opposite and equal to what you owe to the other partners. Therefore, you just pay them. Everybody will go their way. Otherwise, in most cases, the last entry is you just realize we owe partner A 5 million, partner B 3 million, we owe partner C 2 million. Add them somewhere, we realize we have 10 million we owe to them. Go to the bank, get the balance in the bank, I realize it's another 10 million. Good. Just pay the partners and everybody will go their way. Yeah? Otherwise, we are adding and saying if a partner's capital is a debit, then he pays us. Debit, bank, credit is capital, account. Good. So let's continue with the other entries that were remaining as part of the notes. Let's continue. We were at number 10. In other words, we had finished number 9. Now we go to number 10. Now we go to number 10. So let's put down the remaining entries in the books of the partners. Let's put down the remaining entries in the book of partners. Number 10. Ikaivi. 10. Distribute. Distribute the undistributed profit. Distribute the undistributed profit. Distribute the undistributed profit or loss. It could be a loss. Distribute the undistributed profit or loss among the partners. Among partners according to. Among the partners according to their profit and loss sharing ratio. According to their profit and loss sharing ratio. In other words, do that appropriation. Share it. So there is nothing to say you debit, you credit. It all depends with the question. But the point is, these guys are converting at the end of the year. They traded for the whole year. Therefore, they made a profit. That profit belongs to them as partners. Share it. Yeah? Good. Number 11. That was number 10. 11. 11. Maybe close. Close the partners. Close the partners' current accounts. Close the partners' current accounts to their capital accounts. Close the partners' current account, their capital account. Close partners' current account, their capital accounts. Close the partners' current accounts, their capital account. Close current accounts to their capital accounts. Can you say that below that? Number A, below that, number A, if a partner's current account, if a partner's current account is a credit balance, if a partner's current account is a credit balance, debit, partner's current account, debit partner's current account. We are closing the current account and you credit partner's capital account. Debit partner's current account, credit partner's capital account. Yeah? Good. B, if the debit balance, B, if debit balance, that means a partner capital account is a debit balance. How do you close it? Partner's current account is a debit balance. We have said now debit. Partner's capital account, debit partner's capital account, and credit partner's current account. Remember, it was a debit, and therefore to close it, have to credit that current account, meaning you now debit partner's capital account. But of course, it's not something to cram. Just know, close the current account of the partners. Whichever side has the balance, you debit it or you credit it. Transfer the balance to the capital. That's all you need to remember there. You don't have to cram the double entry. Just know, close the partner's current accounts, the capital. That's number 11. Number 12. Finish, we got number 12 now. Finish, we got number 12. Number 12, andika hivi, with the receipt of the purchase consideration. With the receipt of the purchase consideration. The receipt of the purchase consideration, either in form of receipt of purchase consideration, either in form of cash, shares, or debentures. With the receipt of the purchase consideration, either in form of cash, shares, or debentures. Debit, cash, stroke shares, stroke debentures. Remember, you are receiving all this. Debit cash if you are receiving cash, debit shares if you are receiving shares, debit debenture. I told you these are assets to you, not the one issuing the shares. No. Then you come and say your credit purchasing company. Credit purchasing company. Now you can put in bracket data. Remember, in our entry number 3, we charged them 50 million that time. That time we created a data. Now we are receiving from data. Okay? Now we are receiving data. Good. That's number 12. That with the receipt of the purchase consideration, either in cash, shares, or debentures. Okay? Number 13. 13. With shares or debentures. With shares or debentures. Distributed. Shares or debentures distributed among the partners. Shares or debentures distributed among the partners. Among the partners. According to the agreed proportion. Shares or debentures distributed among the partners according to the agreed proportions. Debit, partners capital account. Don't forget you are paying them. Debit partners capital account. Credit shares. Debentures. Remember, you are using these assets to pay them. There were assets as a debit. Now you are crediting to pay them. Okay? Now you are crediting to pay them. Good. That's our entry number 13. I want to go to number 14 and the last one now. I want to go to number 14 and the last one now. I want to go to number 14 and the last one now. Finish. I introduce number 14 now. Already we have said it's to pay the partners. Because we are doing the last thing now. There was a cash we have not distributed. You hope you remember. Is that cash we have not distributed? Still waiting. Listen, that's where I was telling you, listen, get the capital account of partner A, note it somewhere. Get the capital of partner B, note it somewhere. Get the partner capital account of C, note it somewhere. Where we were saying, get 10 million. I'm assuming. Go to the bank account, get the balance in the bank, you realize it's 10 million. Settle them. Close the partners. That's exactly what we're trying to do now. Say this. Say this. For 14. The balance of the partner's capital account, or the balance in the partner's capital account, balance in the partner's capital account, balance in the partner's capital account should be opposite and equal to. Balance in the partner's capital account should be opposite and equal to the balance in the bank account or in the cash account. That way. Balance in the partner's capital account should be opposite and equal to balance cash account. And you say this, if so, pay the partners what is due to them. If so, pay the partners what is due to them. Debit partners capital account, debit partners capital account, credit cash. Because cash and bank is the same. Debit partners capital account, credit cash. Hapo chini unaweza andika NB. Hapo chini unaweza andika NB. In case a partner's capital account is a debit balance, in case a partner's capital account is a debit balance, in case a partner's capital account is a debit balance, then with the amount received from the partner, debit, bank or cash. Remember, we are receiving from the partner. Debit bank, debit cash, credit partners capital account. Credit partners capital account. Said in case a partner's capital account is a debit balance, then with the amount received from the partner, because he will be required to pay debit bank or debit cash, credit the partner's capital account. Okay. Finish. I want to discuss the entries of the other entity now. Finish. I want to discuss the other entity. That is the company now. Company that is buying us. What will they do? I told you them they are going to open their accounts. While you as partners, you are closing your books, them they will open their books. Okay? Finish. I want to discuss the book company now. Okay, listen to this now. Just in an overview. Before we go to the books of the company, listen. In the books of the company, there are not many as we have gone through. Books of the company, they are not as many as these ones. There are only 6. But even here, listen, even in the books of the partnership, I have told you this, that not all these entries will be tested in a question. Listen, not all these entries will be tested in a question. But you should get an overview of how we are closing books of the partners. Get an overview. Listen, the overview is here. Close the assets. Close the liabilities. Charge the company. Those 3 you should. Close the assets taken over. Liabilities taken over. You charge the company. Those 3 will always be. The others, like assets being taken over, being sold, liability being taken over, being paid. That's not a common item. In case come, I've talked about them. Yeah? Not even talking about them. Listen, in case they come, you can use your knowledge of accounting, rules of double entry to record. You sold or you paid a creditor. It's obvious. You as partners, you paid your own liability. You debit the liability, you credit bank. Just a minute. Just a minute, sorry. Okay, now we can continue, sorry. Okay, so let's continue. So I was saying, paid the liabilities. Those are normal double entry. Those are normal double entry. So for number 4, 5, 6, 7, 8. On number 4, 5, 6, 7, 8. Don't struggle. Because those are not a must come in any question. 9 must balance the reality. Want to know whether you sold your business at a profit or loss. Balance. Share that profit on reality. But 10, not a must. Why? Because you may have converted your partnership by the beginning. So there is nothing to distribute as what we are calling undistributed profit. So if you realize from the question we have converted our partnership by January, there is nothing to share. We have not traded as partners. But if we are converting at the end of the year, then for the whole of this year, we were still partners. We are entitled to something. Yeah? That's number 10. 11 is related to number 10. 10, distribute the profit. As you keep distributing, you are updating current account. Okay? Then now close the current account. Because I told you, you can't pay the partners on a piecemeal basis. That means what you owe them capital, you pay them through capital. No. What you owe them through current account, you pay them through current. No. Consolidate. So consolidation is something that have to be done. Because somewhere you will still find some balance in the current account. Whether they traded or not, it's still at current account. So you have to close the current account of the partners to the capital. That is step number 11. That should be done. That should be. Then, well off, receive the purchase consideration. That should be done. Why? Because you charge the company. In step 3, charge them 50 million. A time will come. You have to receive them. That is our step. But 12, which says with the receipt of the purchase consideration, either in cash, shares, debentures. You are receiving them as assets. So you keep debiting cash, debiting shares, debiting debentures, and you credit the purchasing company. Remember? Good. Say it. Now that you have received shares, debentures, say it. 10. Distribute the shares and debentures according to need. Who takes over the shares? Whatever the question will tell you. Who takes over the debentures and at what ratio? Whatever it is. These are assets you received. Credit them now that you are distributing. Credit them and you debit the partner's capital account. Okay? Paying the partners either by shares or by debentures. Finally, is the cash balance. We have already said, and in the bank should be opposite and equal to partner's capital account. If it is so, pay the partners, you, them. Then you have dissolved your partnership. That's all we are saying. How do you know whether it's opposite and equal? Told you don't carry down the balance in the capital account? No. Just balance the account, noting the balance somewhere. B, C also. noting them somewhere. Go balance the bank, don't carry down, just note it somewhere. We realize the money in the bank is 10 million and we owe partner A5, owe partner B3, we owe partner C 2 million. That means money is opposite and equal. So pay the partner. You just credit bank or cash, debit the partner's capital account. That way you have dissolved the partner. Yeah? So what I just want you to know is this. Before I go to the books of the company. Close. That's what I did as the first thing. Close assets, liabilities, charge. That's important. Get the balance in the realization. Listen, get the balance in the realization. If there's any distribution, do it. Then receive the company. Receive, that's a must. The purchase consideration with the receipt, it's a must. Okay? Once you receive it, distribute shares or the ventures that you received, whichever you are told. And finally, use the cash, pay the partners. Hoping you are getting my point there. Good. Now let me talk about the books of the company. Those ones are not hard and they are not many. Let me talk about now entries in the books of the company. Entries, the books, don't write. Entries in the books of the company now. Those ones are not many and they are not hard. Number one, listen. Number one, with the purchase consideration, we are now looking at ourselves as a company now. I told you we are opening the books. So, with the 50 million that we took as the purchase consideration, listen, that is an amount I owe, me as a company, I owe the partners. I have not paid them yet, but I owe them. Just like the partners were creating a data in the books of the partnership, you as a company, you create creditor, or in other words, a liability that you say you are owing A, B, and C partners, owe them 50 million. Number one says the purchase consideration will debit account we shall be calling. See whether this is enough. Shall debit an account we shall be calling business purchase. This is the operating account here. The 50 million, debit the business purchase, and you will credit the sellers. Who are the sellers? A, B, and C partners. You owe them that 50 million. A, B, and C partners. You owe them that 50 million. That, in other words, we are saying you've created a creditor. That's number one. It says with the purchase consideration. Number two, you as a company, you are a company now. You took over the liabilities of company A. Liabilities taken over. These liabilities that you, XYZ Limited, you are taking over, they become your own liabilities. They become your own liabilities. We all know liabilities always a credit balance. So, we'll debit business purchase. Whichever the liabilities, the question will tell you. Debit business purchase, and you will credit liabilities. Whether it's bank loan, whether it's creditors that you took over from them, that is your liability company. Debit business purchase, and you credit the liability, whichever it is. That's number two. Number three. Number three, with the assets taken over. Assets taken over. Listen to this. Now, at agreed values. That's important. Listen, at agreed values. In the books of the partners, get the point? The books of the partners, it was our first entry. That time I told you, close all assets taken over at their book values. At their book values. This time I'm saying, with assets taken over at agreed values. The question might tell you, as a note somewhere, XYZ Limited took over the assets at the following values. Machinery, 2 million. Maybe it had a book value in the books of the partners at 1.2, but maybe the partners, the company now decided to take over at 1 million. So it's not the same. Okay, you may be told they are taking it over again at book value, no problem, but you should be told. The question will tell you how the company took over the assets. Whether you took them over at the original book values or you took them over at fair values, whatever the question will tell you. Find that in some cases, some of the assets are taken over at book value, some are taken over at the fair values, whichever the question will tell you. But the point is, which values you, as a company, taking over those assets? At what values? You recognize them as asset to you. What will you do? Debit asset and you credit business purchase. They are assets you are taking over. Assets are always a debit. You will debit asset, be it machinery, motor vehicle, furniture, building, and so on, and you will credit business purchase. That's our entry number 3. 4. Number 4 is this. There will be a balance in the business purchase. There will be a balance in the business purchase. That balance in the business purchase will either be what we call goodwill. It will either be goodwill or what we call capital reserve. Either be goodwill or capital reserve. Let me explain. As a company, I'm going to pay this partnership or these partners how much? 50 million. That's what I'm going to pay them. That is the purchase consideration. Okay? That's what I'm going to pay partners. 50 million. If you look at the credit side of this account, those are the assets I took over. Me as a company, I took over those assets. I also took over this liability, the debit. When I compare assets and I minus liabilities, I take assets and I minus the liabilities, what you remain with is what we normally call the net assets. So when you take assets, you minus the liabilities, you remain with net assets. Listen now. Suppose the purchase consideration is 50 million, but the net assets you as a company you are taking over, 45 million. You are going to pay the company, you're going to pay the partnership 50 million as the purchase consideration. But the net assets taken over, 45 million. The question is this. Why should I pay more to acquire less? Why should I pay more to acquire less? I'm buying assets worth 45, but I'm going to pay 50. Why should I pay more to acquire less? Means that I must have bought something. Difference of 5. I must pay it extra 5 by something. Is it that I'm buying? I am buying the goodwill of the partnership. I am buying goodwill of the partnership. So we normally say, if the purchase consideration is higher than the net assets taken over, then difference is goodwill, which automatically in the account called business purchase, it will be on which side? Debit, 5 million. Why? Because the purchase consideration on the debit is high. Net assets taken over. Debit goodwill as asset, mark you, and you will credit business. What you will do as a company. Let's go to the other part. What if, listen now, what if the purchase consideration is 50, but the net assets you are taking over, 55? You are going to pay 50, but you are taking over assets amounting to 5. It means you are paying less to acquire more. Paying less to acquire more. Means you as a company, you are buying this partnership at a profit. Buying this partnership at a profit of 5 million. You are paying 50 to acquire 55. So you are paying less to acquire more. Must have bought this partnership at a profit. That profit is what we consider capital reserve. Consider it as a capital reserve. In other words, if you look at this business purchase, the credit side now is more than the debit. That's what we are taking. Credit side of the business purchase now more than the debit, means the assets are more than the purchase consideration. In other words, the purchase consideration is less than the net assets taken over. Difference is good, a profit on purchase. That profit on purchase is considered as a capital. Debit business purchase, you'll credit capital reserve. You'll credit capital reserve. Okay? Good. That's number 4. Number 5. Number 4 we have said with the balance in the business purchase. Number 5. Now listen, for number 5, I want to take you back to number 1. Number 1 said, with the purchase consideration. 5 said, with the purchase consideration. How much did we as a company owe the partners? How much were we owing to the partners? 50 million. What did we do? Debited the partners, we debited business purchase. We credited the partners' account here. Now listen, time has come as to pay them. Time has come as to pay them. So number 5 said, and I told you, listen, company A could decide to pay by cash, pay by shares, or even debentures. From the other side of the partners' books, we are assuming cash was 10 million. We have been assuming shares was 20. Maybe debentures were 20. But we have been assuming. You as partners, you received them as assets. Now you are the company giving or issuing them. Now listen. Our step number 5 says, with cash or debentures, not talking of shares, cash or debentures, given as a payment of the purchase consideration, cash or debentures, given as a payment of the purchase consideration, you will debit the sellers 10 million, you credit cash. You're also giving them debentures. Debit, partners, owe them credit debentures. You are issuing the debentures. That's our entry 5. Is cash or debentures given as a payment of the purchase consideration. There? Good. Finally, number 6. This is with cash or debentures. Listen now. Number 6. There is still one small thing remaining. What is it? Shares. What is it? Shares that you gave. Listen, you as a company, you gave shares worth how much? 20 million. You gave shares worth 20 million. Listen carefully now. In the books of the partnership, they received the shares worth million. What did they do? They debited shares. Listen, that time, the partners were receiving. Where did I open their account? Shares. Never opened it. I've rubbed. Oh, it's here. 20 million. The partners were receiving shares as an asset. You, listen now, you are the company issuing the shares. We all know, listen now, we all know that when you issue shares, these shares must be credited in the capital. You credit capital. But the point I'm trying to derive is this now. You will have to ask yourself as a company, we are issuing shares worth 20 million, true. But how much of the 20 million is the nominal value of the shares? And how much of the 20 million is the premium on the shares? Why? Because you could have issued the shares at a premium. Let us assume the nominal 15 million, but you issued them at a premium of 5 million to come 20. When company A was receiving the shares, listen, they did not bother to know much of the 20 is the nominal, much of the 20 is the premium. But you, company, you as a company, you know this. Listen, whenever you issue shares at premium, listen, you know this is an accounting rule. Shares are issued at a premium. The premium cannot go to the share capital. You know that. You cannot credit share capital with the amount of the premium. The premium must go to the share premium account. The amount of the premium must go to the premium, listen, and the nominal value of the shares issued is the one that goes to the share capital. That's why you as a company, you must ask yourself, out of the 20 million, how much was cash? No, the shares, the premium. How much of the 20 is the nominal? Let us assume the nominal was 15 million. So with the nominal value of the shares, you still debit the partners because you are paying them. Listen, still paying them, and you now credit share capital. Debit the sellers, who are the partners, of course, and you credit share capital. If the shares are issued at a premium, which I'm assuming, still debit the sellers, and you'll credit share premium. How much? 5 million. Good. So for the company, must separate if there is an element of premium. Of course, if they were issued at par, there will be no premium. For the whole 20 million, just debited partners, just like I debited the debentures. I would have debited the partners with the 20, credited share capital with there. But where you realize from a question that these shares were issued at a premium, then the premium amount must go to the share premium, and the nominal must go to the share. Good. I think I'm through now with the entries in the books of the partners, or the company, sorry. One, we have said, with the purchase consideration. What was the double entry? Here, debited business purchase, credited the sellers. That was number one. With the purchase consideration, you had to create a liability. You owe the partners, you as a company. Number two, said with the liabilities taken over, they become your own. So you must credit liability and you must debit business. That's number two. Number three, told you with the assets taken over at agreed values, those assets become yours. Keep debiting machinery, motor vehicle, furniture, and you credit business purchase. Four, said with the balance in the business purchase being either goodwill or capital reserve. That's number four. Five, with cash or debentures given as a payment of the purchase consideration, credit cash, credit debentures, and you debit sellers who partners. Okay. Finally, use the shares. Said shares are issued. Have to ask yourself, what's the nominal value of the shares? Said shares are issued as a payment of the purchase consideration. Then, with the nominal value of the shares issued, debit the partners, credit capital. If the shares were issued at a premium, debit the sellers still as the partners, credit share premium. Okay, good. Maybe we can stop there for now. We pick it up from there next time, when now I'll give the summary notes. Give the summary notes on this. Then we now start question. Otherwise, I've discussed the both books of the partners, discussed the books of the company. Okay. Just before we go, just as a reminder again, please allow me to remind those who have joined us and they are new. We have said, please subscribe. Hope you have remembered. If you are new to the channel, please subscribe. Okay. Said you can click that subscription button even as you're watching now. Then I said you click also the notification bell. Okay. Now to everybody, listen. Everybody, I think if you like the class for today, I think you can click the like button. If you have liked the class for today, please click that like button. Yeah? Click the like button. Yeah? Then I've also said another issue is tell your friends about our online classes for advanced financial reporting, the advanced level, financial reporting of the intermediate level, and financial accounting of the foundation level, or that of the ATD level 1 and level 2. He said, once somebody joins now, that's what we said, you'll get the videos of the classes you have already missed. That's what we said. We also said, for advanced financial reporting, we have either early morning or evening. Financial reporting, it's evening. That's what we said. Also told you, tell your friends, if they can't join a live class, they can buy what we said. It's called the pre-recorded videos. Pre-recorded videos. You there? Where they get the videos for the whole syllabus and they watch them at their own free time. Yeah? That's another thing I said. Yeah? I gave you my contact, 0722 65 8875. Somebody wants to call, more information. Somebody wants to call, more information. Okay? Then I said, as at now, charging 4,200, accepting payments on installment. Accepting payments on installments. Maybe for today we can stop there. Pick it up from there next time. See you now, where I'll give the summary notes on books of the company. Then we do a past paper question. Bye for now. Bye for now. So please subscribe and remember to talk to friends who have not joined the online classes or who have not bought the pre-recorded about our online classes. See you. If you have liked the class, click the like button. Click that like button. Good. Bye for now. Bye for now.